Cash is, well, cash. In a 401k, it's usually available as a money market or stable value fund. Unlike other assets, there's little risk that your money will lose value. But that doesn't mean there's no risk at all. If you hold too much cash, you are at risk that inflation will leave your money worth less compared to everything else. For example, in 1950, a nickel would buy you a Coke. But if you saved that nickel until today, you wouldn't have enough to buy that same Coke. Cash loses value over time. Most people with 401k plans invest in mutual funds. These hold many different individual stocks or bonds chosen by professionals for a given level of risk and potential reward. So, how do you choose the right mix for your specific needs? You may be surprised to hear that according to the majority of corporate pension plans in the world, there really is a single best way. It's called modern portfolio theory. The details are a lot of math, but understanding what's behind all the numbers is remarkably simple. In fact, you've probably already heard of it. Don't put all your eggs in one basket. You balance risk and reward by holding lots of different types of investments. The technical term is diversification, and it's the name of the game in investing. So how do you do it right? Most of us understand that if we take more risk, we expect more return. Let's look at the math. The line shows us that for any given level of risk, we can expect a certain rate of return. More risk, more return. The challenge, as you may be aware, is that markets don't move in a straight line. They go up and down. The goal is to buy low and sell high. When one investment type is down, you want to buy. At the same time, you want to sell an investment that is high. In the long run, they all tend to move up, just at different rates based on risk. Remember, this is your retirement savings, so to invest well, you need to diversify. The goal of diversification is what modern portfolio theory is all about, getting an optimal rate of return for the risk in the long run. To do that, you want to invest on what is known as the efficient frontier. The details of drawing the curve are just a lot of math. You could spend the spare hours of your days creating the efficient frontier on a very large spreadsheet, or you can let experts do it for you. In fact, the answers are already right where you want them, online, and probably already in your 401k plan. Guided Choice can give you personalized advice recommending a specific mix of stocks, bonds, and cash to reach your retirement income goal. You can even use it to try different strategies and project the results. Whether you take the investment recommendation from our brainiacs or choose to do it yourself, hopefully now you're a little more confident about how retirement investing works. Just remember, if you do it yourself, you need to rebalance your account at least annually to stay on the efficient frontier.